How's it feel to be up here?
Feels great.
No pressure.
No pressure, no.
Just hosting the launch of your ETF.
Yeah,
Yes.
yeah.
Well,
Very excited about it.
As I shared when I was introducing you, you remember my response. I was like, what? This is amazing.
Yeah.
So I want to take everyone back to really talk about how did that theory come to you? Where were you? What made you come up with this methodology?
Yeah, well, I thought of the idea while sitting at the Berkshire Annual Meeting. So I'm a huge Warren Buffett fan, and I've been attending the Berkshire Annual Meeting since 2017. And in 2024, I was sitting there when I actually came up with the idea of the Inside Ownership Index. It was the first meeting where Charlie Munger, Warren Buffett's longtime partner, wasn't there because he had passed away. And I put a lot of my clients and my own money in Berkshire Hathaway. And I was kind of sitting there afraid. I was thinking to myself, what am I going to do with Berkshire Hathaway stock when Warren Buffett dies? And at some point during the meeting, someone asked Warren Buffett a question about the S&P 500, and that's when it hit me. The S&P 500 will buy more Berkshire Hathaway when Warren Buffett dies. A lot of people don't know that. So the S&P is what's called free float adjusted market cap, meaning when they count the size of Berkshire, they exclude his shares. And when he dies, those shares become free floating. And I just thought to myself, who would want more Berkshire without Warren Buffett? And who, in the same aspect of any other company, who would want more Tesla without Elon Musk? Or who would want Meta without Mark Zuckerberg, right? So it could be applied to every company. These leaders have created the value of these companies, and if we just replace them with new people, is it really the same company? And so I came home from Omaha and got started.
Just like that.
Just like that.
Yeah, I think it's fascinating that, and I don't know, anybody else might have been thinking that at that meeting, but that you kind of drew that parallel and thought, if he's not here, why do I want the same investment share? If Elon isn't at Tesla, then why do I want this? Jeff at Amazon. And when you shared with me, I thought it was really interesting that the S&P 500 is kind of pitched as like, this is middle of the road. Like you just grab your shares of the S&P 500 and you're cruising along with the market. It's kind of what I refer to as like the average American investment, right? You just buy that. But what you're sharing with us is that you actually are almost at a disadvantage because you don't get to own a lot of the companies that have the founder ownership, and you own more of the companies that
do. Yeah, absolutely. And
seems
to
like
be
a
fair, I think
disadvantage.
S&P has been a fabulous product for most people.
Sure.
It's low cost and it's given people the ability to participate in the market, but I do think it's outdated. Yeah.
Outdated in the sense
of, well, the world is changing, right? And when the world changes, it's mostly founders and those who have skin in the game that really do the innovation. And we'll go through some slides that really show how almost every company in history innovated through ownership.
And do you think that we have more of those companies in this day and age now than we did, say, 20, 30 years ago?
Absolutely. I mean, look at the three companies going public now. OpenAI, SpaceX, and Anthropic. Now, when those three go public, the average top 10 company in the US is going to be founded in our lifetime, right? It's going to be, the average lifetime of those companies are going to be in the 2000s. So it's crazy how all the advantages these legacy companies have, yet it's these new companies that really drive all the value, right? Because they have the leadership. And it takes leadership. You can't hire a Jeff Bezos or Elon Musk or even a Warren Buffett. You can't hire these individuals.
It's interesting, like you say, that it's kind of outdated.
Right.
So it did work for a period of time. And it's not that it doesn't work now, but there's an edge that we can have now. But back then, because there wasn't as much innovation, you kind of cruise along. And maybe you had a couple outliers in there, but really in this period, it becomes drastically more important.
Yes.
I want to talk about some of those companies. Let's take a look at this. This is interesting to me. And I'm curious, anybody know what all of these stocks have in common? You've got Netflix and Amazon, Tesla, all these companies. Any guesses? Family ownership?
No, no. They all, every single one of them, turned $10,000 into $1 million over the last 20 years, every single one. There's about 21 different companies over the last 20 years that if you put $10,000 in, it turned into $1 million. And all these share one other thing in common. They all had ownership. They all had insider ownership at least 5%. The only two exceptions that went on this extreme, massive wealth creation run is Apple and FICO Isaac. There's only two exceptions to the rule. Almost every company, if you want extreme outlier returns, you need ownership.
So you're saying that anyone in this room could have put $10,000 into one of these stocks
And held it.
It
would have turned into over $1 million. It's some more than 1 million, several million.
And you're saying it's this number right here.
Is that
They
number
all
right
had
there?
The inside ownership.
Yeah.
I love your philosophy on skin in the game. So let's just talk about that for a second, because you talk about, well, any of these companies, I mean, pick one, and they have skin in the game. I mean, gosh, what's the biggest one up there? Universal 60%, right?
Celsius, the drink. I mean, had you invested in that company, it'd be several million.
Wild.
Yeah.
And so you're saying inside ownership. So I love that you have the story that you tell about inside ownership. Share with people like what it really means. You're talking about it from a basketball perspective.
Yeah. So in my 20s, my first experience with skin in the game, it really changed my perspective on it. Now, I played basketball every Thursday night for 10 years. And after the first year, my Uncle Dan, as some of you know, said, well, why don't we bet beer on it? Yeah. And the losing team would have to buy the winning team a round of beer. And oh my God, that changed everything. We started pushing each other, diving for balls. We played harder than we've ever played in my entire life. And it wasn't the fact that we had to buy my friend a beer. We do that all the time. But it was the fact that we bet on ourselves. And that's what created that drive. And that it just changed absolutely everything in my perspective on skin in the game.
You get a different performance.
Yeah.
So imagine the Celsius, right? The founder or the current owner who's gotten that much invested in it, he has a lot to lose. 40%
exactly
of that company he has to lose. So it's almost like you can bet he's going to be diving for balls.
Exactly. He's going to be diving for balls. He cares. Mistakes. That's the key. You want CEOs to feel the pain of mistakes. And when you have CEOs that don't own any stock, my perfect analogy is what I call a hired CEO. I compare that to a zoo animal. So a zoo animal gets fed every day, right? In the same way, a hired CEO gets his base salary, quarterly bonus, and very often a golden parachute, right? They don't have to successfully hunt. Now, I call the owner-operator CEOs a wild animal, a wild lion. Now, those CEOs, they have to hunt for their food, and if they don't, they starve. And that's the key difference between a wild lion and a zoo animal.
So the founders that don't have any skin in the game, they're just collecting direct deposit into their account. It doesn't really matter. I mean, maybe they get a bonus or something, but it doesn't matter as much because they don't have 5 to 40 to 60% of their holdings.
Exactly. They're not going to sleep thinking about their company. They're not waking up thinking about it. They're not dreaming about it.
So give me an example, and I want to tie this to both a company that we've seen that in, and also how if we are invested in the S&P 500,
yeah,
and they don't have inside ownership, obviously we're getting more of that in the fund.
Yeah.
And so we take the brunt of that.
Exactly. So the best example I have is Silicon Valley Bank. In 2023, Silicon Valley Bank went to zero. Now, most people don't know this, but if you owned the S&P 500, you had exposure to Silicon Valley Bank. Now, insiders owned so little that it was represented by an asterisk in their filing. And the next slide, I think we have it. Yeah.
Yeah.
Yeah, there you go. So you can see this is a snippet from their proxy filing. Insiders owned so little that it was represented by an asterisk. So they owned no shares. So this is the problem with most companies when insiders don't own any stock. What they can do is leverage up the company, aim for home runs, and when they're wrong, it's no skin off their back, right? But if they hit a home run, then they get their large bonuses.
It almost seems like if we're the investor in the regular S&P 500, we take the leftovers.
Exactly.
Because if Celsius was there, they've got 40% of the company, so we're actually going to get less of Celsius. But for Silicon Valley Bank, they're like, well, there's no founder, so we're going to push this over into the index.
Exactly. So here's a pie chart. Now, if insiders own nothing at Silicon Valley Bank, who did own Silicon Valley Bank? Well, it was the passive funds, Vanguard, BlackRock, and State Street, right? So this is creating a systemic problem where if you have terrible CEOs, there's no longer any mechanism to remove them because these passive ETFs don't vote for the removal or change in board. Now, what you want is a healthy company like Amazon where insiders own a significant part. You know, Jeff Bezos owns about 10%. The rest of the other board own 2.5%. And, you know, when you're talking about a $1 trillion company, that's a lot of skin in the game. And you see it in the returns.
And so obviously this side of it, this is where you see the companies, the investment, 10,000, over $1 million.
Yeah.
Give me one of your favorite examples, an all-time favorite of a stock that has had that inside ownership.
Yeah, so
it's grown.
Intel is a prime example. Now Intel, Andy Grove, the longtime CEO of Intel, had you invested in Intel when he became the CEO in the 70s, $10,000 would be several million by the time he retired. They had, at this peak, they had 90% market share in the PC microprocessor business. It was a dominant company. Almost every computer you could find out there had an Intel chip in it, right? And then we could see what happened with the Intel stock the moment he retired. Now, he retired in 1998. Fast forward 27 years, is virtually no growth. This is not the exception. This is almost the rule. When those responsible for the growth of a company, the success of a company leave, the companies begin to erode.
And you know, I think it's interesting. I'm curious from all of you all, like, if you own the S&P and most growth funds, period, right? Like they had Intel in it, so it's like, oh yeah, I owned Intel. And as it was going up, we were making a lot of money in that fund. But then nobody really knows that anyone retires, and the index just
exactly. Indexes don't pay attention to that, right?
Yeah.
I always ask a thought experiment to people. Now, imagine a very successful company, right, run by very successful people. Now, overnight, you replace that group with entirely new people. Would you call that company the same? Right? And most people would say no. But the S&P treats that company exactly the same, and it isn't.
And so when he retired, I'm assuming his investment, he liquidated a lot of his investment.
Well, he's no longer an insider, so he's free to sell. So we don't know what he's doing with his shares, but he's no longer part of the company.
So we don't get that data, and then the S&P says, okay, let's buy more of this company because there's no inside ownership.
Exactly. Yeah.
So more in our pockets in the S&P 500.
Exactly.
Yes.
Yeah.
So we rode this.
Yes.
We were in the S&P 500.
Yeah.
Yes.
Yeah.
I love another one of your stories, IBM.
IBM is a great story. So if you think back, the most dominant company in US history was IBM. And by dominance, I mean by relative size. So IBM, it's kind of hard to see, but was more than 2.5 times, or more than 2 times larger than the next largest company in the world. So this would be like NVIDIA being a $12 trillion company today. It was dominant, it was massive for its time. Now, a lot of people don't know this, but Thomas Watson Sr. was the founder of IBM, but it was his son, Thomas Watson Jr., that took IBM public in the 50s and ran IBM as a CEO until 1971. Now, he stayed on the board until 1984. So you can see that's peak IBM, 1984. Fast forward just 8 years after his retirement, IBM is not even in the top 10. Now we're talking about the most dominant company in history. And it's not even in the top 10 just 8 years later. It's not even in the top 25 today. So again, this is not the exception. This is the rule. When those responsible for the success of a company retire, it changes the company.
So just to clarify, the decisions that are being made there now, the decisions even after 1992 or when he retired in 84, right? That it's just different mentality, different philosophies.
Exactly. Cultures erode. Layers of management, bureaucracy, they creep in once those with ownership leave. When you have a board with no ownership and a CEO with no ownership, their goal is to hit the quarterly numbers, but long-term value is not created that way, right? A CEO with ownership, they're thinking in decades. Jeff Bezos never cared about the next quarter number, right? Amazon operated at a loss for a very long time, but that's how massive returns are made, thinking in decades and not in quarters.
It makes me think of CNBC. Anybody watch CNBC at all? Ever have that on? Yes. And you would hear here's the quarterly numbers coming out, and Amazon back in the day, and it was like they were always negative. And some people would go, oh my gosh, how would you buy a company like that with their PE ratio and their book share value? But in the long run.
Right. I think people have paid too much attention to last year's earnings and not enough attention to leadership and what they've done in the past and how much they own.
It's interesting kind of investor psychology of going, well, this company isn't necessarily hitting their numbers and they're losing. You have to really bet on that person and what their philosophy is, what their plan is, versus sometimes the company comes out and they're hitting their numbers.
Yeah.
Right?
Yeah.
Maybe it's the non-founder, led or invested, but they're hitting those numbers, and somehow that gives people some sense of satisfaction.
Right. I mean, if you just think about Tesla, for example, the people, and some of you know people who have made a lot of money investing in Tesla, and there's been some people that made a lot of money investing in Berkshire for a very long time. And if you chart a graph of those who understand financials and those that just trusted the leadership, those that trusted the leadership are the ones that made all the money, right? And they just held. They trusted Elon's mission, and they held. And those are the ones that really made all the wealth.
Remarkable. Does anybody in here have like a favorite leader? When you think about a company and like, I'll follow that leader, I'll follow that philosophy.
I was thinking about Elon Musk when he bought Twitter. He got rid of all the employees because there's so much fluff in there.
Exactly.
I don't know if it's making money.
He got rid of, I think, 80% of the employees, and it's still operating today, right? I mean,
It shows you how bad a company without leaders is going.
exactly.
Yeah.
Or the right leaders. Twitter did have a leader, but not a good one.
Another example.
Yeah.
Well, we've kind of talked about this back and forth, but I really want to pull up the slide to illustrate, because I think when you see it, about how a company, how the shares fit in. So give us some intel here.
Yeah, so this is a really important graph here. This is what makes inside ownership special. Now, if you want to improve your returns, what you want to do is get more exposure to the best performing stocks, right? And you want to have less exposure to the worst stocks. Now, in July of 2020, Intel and NVIDIA were exactly the same size. They were $250 billion companies. They're doing the exact same thing, designing chips. Now, Intel at that time had 7 times the revenue, 7 times the profits, and a higher return on equity than NVIDIA did. But they represented identical weighting in the S&P because they were both $250 billion. Now, in the inside ownership index, because NVIDIA had one thing Intel didn't, it had a wild lion as a CEO, right? Jensen. So we had more than 2.5 times exposure to NVIDIA and no exposure to Intel. And fast forward 6 years, Intel is up maybe 100% at best, and NVIDIA is up more than 2,000%. So this is the difference. You get more exposure to the best performing companies, the most innovative companies, by betting on leadership. This is why the inside ownership index is a better constructed index philosophy than the S&P 500.
Talk to us a little bit about the passive and active, because I think this is a great place. It almost seems as if the S&P 500 obviously is just passive. It market share, market cap, and it owns those companies. Inside ownership has a little bit of a blend.
It has a little bit of a blend, but it is 100% passive. So it is completely a passive index. The difference is the S&P indexes to the corporation. We index to the leaders running it. And when the leadership changes, now we have new leadership, we're not going to treat that company the same. So we're indexing to the leaders. So it's still a passively managed index. I'm not making any decisions. S&P 500 is the first filter. So the S&P 500 decides which 500 companies go in, and we take the top 100 from there based on ownership.
And so how often do you do that?
And it's rebalanced every quarter.
So every quarter you're looking at the 100 companies and you're saying who still has the inside ownership. If Andy Grove, right, he left and he's no longer got that, then you are making that shift in the portfolio.
Correct.
In the index.
Correct.
Okay. So the longest could be 3 months.
The longest could be 3 months. Correct.
Yeah.
Yeah.
So is it just the insider ownership that makes the company get into the index with your ETF?
Yes, so the first filter is S&P. S&P decides which companies we are able to look at, and then we take the top 100 based on insider ownership, the dollar value. And it's not the percentage, it's the dollar value of insider ownership.
And nothing profitability or nothing on...
Nothing else. So for example, the S&P only looks at market cap, right? S&P is a great index, but all it looks at is the market cap, the market value of the company. We look at the market value of the ownership that the leaders have instead of the entire market value. We're only looking at the market value of what the leaders have.
Because talking about SpaceX, right? I saw your comment on LinkedIn yesterday about it not being included in the S&P until maybe a year down the line.
Right.
So it's not eligible to be put into the ETF.
Correct. And I'm actually very happy about that because it is founder-led and it's a very high market value of ownership. It would have been a large position in our index, which has me concerned. I do think it's a little bit overhyped. So I'm glad the S&P is waiting the full year before including it, and therefore it'll take a year before it gets in the inside ownership index.
And if it would have been included in a week, then you would have had it.
Then I would have it. It's entirely rules-based. So we follow the S&P 500 rules, right? The S&P 500 has done a great job in deciding which companies get in, and we just follow their lead.
So you don't cap the main target.
They have some criteria. They have 4 quarters of profitability, and I think they have some additional
Dividend.
no, they don't have to pay a dividend. No, Berkshire hasn't paid a dividend in forever.
So why only the S&P 500? Why not the New York? Why not the mid cap? I'm just curious.
Sure. So mid-cap is a great example. Now, what we want is to capture the outliers. We want to ride those outliers and make a ton of money when those outliers really have the big runs. Like, for example, NVIDIA, Tesla, Berkshire Hathaway. Problem with the mid-cap is the best performing companies leave because they're no longer mid-caps, right? They grow out of it. So you don't get the exposure to those companies for the long term. What you want is to ride those really well-performing stocks for yeah.
NVIDIA throws, I think, 9% of the benchmark now. You don't cap it. Do you mechanically just say no?
We don't. Yeah, well, that's a good question. Now, the NASDAQ, for example, is not even market cap weighted anymore because ETFs have tax law rules. They have certain concentration rules. So one position in an ETF can't be more than 25%, and all the positions above 5% can't be more than 50%. So there's adjustments made to lower that threshold. So that's the only, we just comply with US tax law. But we do cap the ownership at 5%. So we don't cap the individual positions. We have NVIDIA currently in our index at 11%. So it's a very big, it's even more concentrated than the S&P 500. Yeah, yeah.
Great questions. Any other questions right now?
It's a conceptual question. If I was a VC specializing in seed round investment structures, at that point I'm effectively betting on the founder. That is my investment thesis, and it just happens to be the vertical I'm in. You're effectively giving me VC type exposure, but on the other end of the spectrum, because your index effectively makes it easy for me to bet on the other.
That's 100% true. So indexes are driven by power law, and same thing with VC, right? VCs bet on 100 different companies, and maybe one or two produce all the gains for the entire portfolio, right? Well, in the same way, the S&P, there was a study done by a professor at University of Arizona. He studied all stocks in the US for 100 years. And what he discovered was it was only 4% that delivered all the gains. The other 96% of stocks matched US Treasury bills. This is why it's so hard to beat the index. Now, if you want to improve your returns, how do you get more exposure to that 4%?
Yeah.
And it's betting on the leaders.
So I can do better than Treasury bills.
You could do better than Treasury bills, but yeah, exactly.
I always thought it was interesting. I mean, I was at Morgan Stanley in the IPO days of like the dot-com bubble, right? And it always felt like, even we talk about Anthropic coming out and these IPOs, it's hard to get exposure. It's hard to get that shares on the IPO, as they come out.
Right.
And it always felt like other people got them, that you didn't have the same advantage. And that's what I love about your index, is exactly what you just said. It feels like this is an easy way to have somebody else doing the work of getting that advantage.
Exactly. Yeah.
So how do you invest in it? It trades.
Yeah. So we launched an ETF last week. Thank you. Yeah. The ticker symbol is OWN, OWN. Very easy. You just log into your own brokerage account, and as you see fit, you allocate money to the market. Now, I'm sure all of you are investing in the stock market at some level. And what I ask people to do is actually replace the stocks or ETFs that they already own. I'm not really asking people to put new money into the stock market unless it's part of their dollar cost averaging plan. But what I say is replace some of the stuff you already own. The stock market is very overheated, right? I don't know the direction of the stock market, but we should all be owning stocks. And what better way to get exposure to the stock market than investing in owner-led operators?
Is an easy switch for me, anyways. It was an easy switch to make in my IRA account,
Right.
because I didn't have a taxable consequence of getting out of, SPX and moving over, which was nice.
And what I ask everyone to do is actually at least own 100 shares. 100 shares.
I mean,
right?
it's only how
$24
much?
a share.
$24 a share.
Yeah.
Yes. I do want to ask you about this, though, because I think it's important. Volatility. We talk about returns, and you have a lot of historical returns. What is your opinion on how this particular ETF performs in volatile or in bear markets compared to the regular S&P?
That's a great question. I actually have a slide for that one. So we are more concentrated. We're more concentrated than the S&P. We have only 100 stocks in our index, and we're putting more exposure to some of the big names in there. And so we're more volatile. But what's very interesting is the two global catastrophic events we've had in the last 20 years. So we've had the Great Financial Crisis and COVID-19. Now, the S&P had a deeper drawdown during those two periods. So when the world is really going to shit, the high inside ownership companies basically held up better. They were more resilient. They have better balance sheets. They're owner operated. So when they need to make changes, the world changes, they adapt. And they basically held up better during the two periods you needed that safety the most.
I think about that now in this environment because some people would make the argument that the market is expensive right now. But I think about the fact that having that inside ownership, they're going to move differently. Was it Warren Buffett that said, be greedy when people are fearful and fearful when people are greedy?
Exactly.
So it's like they have a
Yeah.
different mentality. If everything's falling apart, they might be capitalizing on something instead of running scared and trying to protect the numbers for the shareholders or the board.
Yeah. You know, I'm actually not exactly entirely sure. Are people greedy right now? Or I know a lot of people have cash on the sidelines. I think, so it's kind of a weird period where equity prices are extremely very high, but people have a lot of cash on the sidelines. So it's kind of interesting.
Yeah.
Like, for example, Berkshire Hathaway has 400 billion in cash. So we really get the big crashes when everyone's fully invested. So I don't know exactly when that crash is coming, but
I get excited for this. Does anybody else, do you guys get excited or do you get a little nervous? Yeah. It's like a sale. It's like everything is on sale.
It's kind of like if it's going down like that, that means there's opportunities everywhere.
Right.
It's never a down market. It's just buying opportunities.
Yes.
yeah, dollar cost average, right? Always be regularly buying. As the market
Yes.
goes down, you end up with buying more.
Yeah.
Depends why it's down.
Yeah.
Well, the timing of when and how long and all of that is always uncertain. But I don't know, I love those opportunities
Yeah.
because, and maybe I'm optimistic, but I always feel like historically, we always come out the other side.
Absolutely.
Right? Yeah.
So looking at that chart, which is really insightful, thank you for creating that. My question is, do you have like like if one of the positions out of the 100 that you invest in, if it starts tanking, do you have like a stop loss or you just hold on to it for dear God?
It's a passive index. So in the same way the S&P would treat it, we would treat it the same way. You're invested in 100 different companies, and there will always be one that's tanking, but you know, hopefully the others make up for it, basically.
So you would just hold on to that bad boy.
It does get rebalanced out every quarter, so it would if it got tanked, then it would not be in the top 100 based on ownership, right? Because that dollar value would fall, and it would be excluded from the next rebalance.
Thank you.
Any other questions?
Yeah, so you were talking about how you wouldn't want to own Berkshire Hathaway without Warren Buffett. Well, let's say in the scenario of a CEO or founder passing down their leadership role as well as their stock to a child or like their children or something like that. What's your philosophy on that, I guess? Like, do you still believe that they're going to be as innovative as their, parents or something like that?
Yeah, that's a really great question. And the perfect example to that one is Walmart, for example. Walmart has one of the best performing stocks of the last 50 years. It was founded by Sam Walton, who had one department store in like Arkansas and turned that into like 30,000 different locations. But when he died, he left all his shares to the Walton family, his two sons and daughter, and they remained on the board. So Walmart is family-run company, extremely successful, right? When that ownership, the family ownership is maintained, now they're not the CEO, but that ownership remained at the top. So they are thinking long-term. So Walmart has continued to perform really well, despite it not being founder-led anymore, but it's still owner-operated or family-operated. So, for example, if Warren Buffett left all his shares to his son and his son remained on the board, he's not going to because Warren Buffett already said he's going to donate that out to foundations. But if he did, then I would think that Berkshire can maintain its culture of thinking long-term. But the problem is when you hire a CEO and they have no ownership, they automatically have to perform every quarter, and then that's their mindset is to think quarterly, right? Think about all the decisions you can make that may make your company look bad now, but you know it's going to create long-term value, right? They don't make those investments because they want to look good now. And when you maintain that family ownership, they keep that good culture that you want.
It's almost like they want to protect the legacy.
Exactly. Yeah.
So procedurally, does that company still stay in your index when it has that succession plan down to the second generation?
Yeah, so if that ownership, so what we do is simply go to the proxy filing, and every quarter or year, a company puts out how much their C-suite and board own. So we look at that figure, and if that ownership is still there, then it'll still be a position in the index.
So, do you see it, like, we know from first to second generation, it kind of retains its value. Second to third is a really big jump. Statistically, it loses a lot of value when it gets to the third generation ownership, even if it's family owned.
Yeah, so Walmart, for example, the founder's son, Rob Walton, he just retired. So as of like 6 months or a year ago, Walmart is not family run anymore. So now we're out of Walmart. So now it's on the third generation. But yeah, you're right. Most companies will do well multiple generations, as long as those generations are involved in the company, overseeing it. But most companies start to die after either the first generation, if their children don't take any part in it, but if they do, it usually lasts about 2 generations. Yeah. I don't know of any third generation companies. Anyone here?
I just think in general, right? We know like wealth succession. First generation makes the money. Second sort of will grow it, and then by the third generation they just sort of.
Yeah, but for example, the Vanderbilts are broke now, right? A lot of these super wealthy families, once the children acquire that wealth and don't participate in the companies that were founded, usually squander that wealth eventually. Yeah.
How many such companies you have in your ETF?
100 different companies.
Is it family owned?
They're not family owned, but they're owner operated, or it's based on ownership basically.
Okay.
Yeah. So we have Apple, for example. Apple's in the index because Tim Cook and one other director, they own more than $1 billion each of Apple. So Apple is part of the index, but S&P has a bigger position in Apple than we do.
I'm curious, upon launch, what are the top 2 sector weights at the moment? Obviously, technology is the one, but what are the top 2 sector weights in the
Technology and communications. So like, for example, Google and Facebook, they're no longer, they just kind of play around with the terms, but they're now in communications.
How much of the index of your index is that in those 2 sectors now upon launch?
Upon launch, I would say it probably makes up 60%. Yeah.
Benchmark 45.
Yeah. So we're more concentrated. Yeah.
It almost makes sense because right now, if you're looking at innovation in space.
Exactly. Yeah.
So you're a proxy for an innovation index.
Yeah. And you know what, that actually reminds me. So a lot of people have asked me, well, did you just outperform because you have more exposure to technology and technology is doing well? So I created the technology only inside ownership index. And we can compare that index to the S&P 500 technology only. And the technology only index outperformed by an even wider margin. It outperformed by more than 400 basis points per year compared to S&P 500. So we're getting more exposure to the best innovative companies by weighting the portfolio to ownership.
I want to know from your perspective, obviously you have a ton of passion around this. What lights you up about it? What are you most excited about this index?
I love that I created something, it's good for the world, right? Passive indexing has really put, in the past, if you wanted to buy a stock, right, you called up a stockbroker. Now, everyone knows the stock market earns around 10% per year on average, but there's always been intermediaries between the 10% and yourself, an investor. And usually stockbrokers took 2%, and then it became a mutual fund. And ETFs have really given that power back to the individuals. They could go and buy ETFs themselves and save for the long term and not have to pay financial advisors such a big fee. And so I'm just really excited that I created what I think is great for the world. And it's also correcting the systemic problem I talked about with the S&P. The S&P is really reducing the accountability amongst CEOs, right? Because when there's no ownership and nobody's voting the shares anymore, as the S&P takes market share, I think 20% now of corporate America is owned by these passive funds and nobody's voting. So now you get these terrible CEOs that get locked in and there's no longer any way of getting them out, right? Yeah, so if an ownership weighted index could take market share, then we bring accountability back.
That's so interesting because,
Yeah.
again, I think that we just get kind of neutralized and accustomed to, well, whatever the S&P 500 does, and not even understand or know that what that shift and lack in accountability is causing.
Yeah, yeah.
You're like the ETF man for the people.
Yeah, yeah. I think so, yeah.
I love it. Any other questions?
How are you involved in this?
Me? I just like to talk about this stuff. Oh, thank you. I am a business strategist. So Haren came to me when he was launching his fund, and we started talking about how to bring it to life and how to market it and speak around it.
She's helped me with all my communication around it since 2 years ago. So we launched this 2 years ago. The strategy has been live for 2 years. The ETF now is available to any individual who wants to buy it. But in the past, clients had to work with me directly to invest in the strategy. Now, nobody has to work with me. They could just simply buy the ETF.
It was a big lift, like when you first started doing that, because people had to go and they had to work with a certain broker and open up a separately managed account and go through layers of paperwork in order to have an investment like this.
Exactly.
And your goal, I actually think your goal was a year to turn it into an ETF in 6 months.
Yeah.
6 months you made it happen.
Yeah. So a year after meeting you, but it ended up being only 6 months, right? Yeah.
Right. Yeah. And I just love it. I mean, this is my background, so I love it.
Yeah.
What's the ETF?
So it's just under 0.5%. It's 49 basis points. And we plan to bring that down as we gain AUM.